Mike Barnes, hello.
Hi, Jean-Baptiste. Thanks for having me on.
Yeah, it's a pleasure to have you. You're the European Research Associate Director of Commercial Research for Savills. Your company has published recently a survey, which is called the Spotlight European and Middle Eastern Investor Sentiment Survey. And as we can see from the highlights of this survey, is that as the higher debt costs tend to lower the transaction levels throughout Europe, pan-European investors you surveyed show an increased appetite for risky and value-added assets. Um, my first question is, what is restraining them at the moment?
Great. Yeah. Well, I think as you mentioned, investors that we surveyed doubled their risk appetite year on year. And again, that's we're seeing more capital raised for value add and opportunistic strategies across Europe over the course of this year. I think perhaps what's restraining investors at the moment, the top three themes were that debt costs still remain too high to borrow. So again, that's going to be limiting certainly the core transactions, which is why we're seeing value add dominate over the course of this year. There's generally an expectation that there's further price adjustment required. And given that that distress perhaps hasn't come through fully yet, I think over this next sort of 3 to 6 month period, there's going to be, again, a little bit further outward movement to go. But I think that's going to vary across the different commercial sectors. And I think finally, investors are saying that there's a shortage of suitable stock. The stock that is being returned to the market is not reflecting what they want to be buying at the moment. So I thought it was interesting that dry powder wasn't one of the limitations. There's been capital raised, it's ready to deploy, but investors are being more selective, and again, perhaps more of a focus on refinancing their existing assets. And this sort of reflects the survive till 25 theme that we heard around Expo more recently.
Oh, okay. And what type of, you've talked about strategies, what type of assets and locations are they focusing on, or are they willing to get their hands on?
So, I mean, having a look first at sectors, again, it was a similar theme to last year in that beds and sheds were the main sectors that investors want to increase their exposure to. Interestingly, beds jumped to the top as the top sector. Urban logistics, big box logistics, again, sort of supported by the e-commerce trends and nearshoring that's sort of driving occupier demand across Europe as well. And perhaps the fact that prices have adjusted faster than in other commercial sectors as well. Looking at the living sectors, again, there's population growth, there's a chronic undersupply of residential of homes across major European cities as well. And again, looking at the demographic story, there's an aging population which is supporting demand for senior living. We're seeing uncertainty perhaps around the jobs market, which is seeing an increase in student applications for university places, and again, more demand for student beds. And again, I think retail warehousing as well. One of the sectors that perhaps had adjusted pre-interest rate rise, which again is, and as consumer confidence comes back, maybe less impacted by the increase in debt costs than the other commercial sectors as well. One of the interesting changes has been CBD offices, where sentiment has weakened year on year. I think a lot of this is down to the slower price adjustment, and again, some of the concerns around vacancy rates and occupancy rates, how many people are, the speed of return to the office. But I think if you compare some of the responses from the US or Canadian respondents, and again the European respondents were twice as likely to invest in CBD offices. So I still think there's a sort of a positive narrative around the office market, and I think especially the asset management story, turning older offices into new green BREEAM certified offices is definitely a big opportunity. Just sort of finishing on the locations, the UK jumped to the most favoured location following the autumn statement from last year, and perhaps the faster price adjustment than we had seen for some of the European markets as well. But otherwise, Germany and France, a desire for core liquid locations among investors.
Okay. And what is your outlook regarding the repricing landing time?
I think that's the big question mark on investors' minds at the moment. Interest rates appear to have stabilized. The expectation is that they're going to remain at the current 4% level until the third quarter of next year, and that gives investors a base for their pricing expectations. And should the economy weaken, or should we see unemployment rise, those rates could come down faster, which could accelerate that price adjustment. So I think what we're seeing in terms of the stress and distress coming through, it's coming through perhaps slower than we had expected at this point. Again, banks rolling on some of the debt refinancing rates that they had previously offered. So I think when the US private equity firms come back into the market, we're expecting that to be in the first half of next year. That will be a good indication of when the pricing adjustment is complete. And I think that's going to come fastest for the UK and the Western European markets, and perhaps the non-core markets to adjust around 3 months later, once core pricing is adjusted as a backdrop. So I don't necessarily think it's going to be a V-shaped recovery. We're not going to see immediate yield compression. I think we may see yields flatten and stabilize once they are at this peak. And then as buyer demand gradually returns to the market, we'll see an increase in transactions, and again, more core deals completed towards the end towards the second and third quarter next year.
Okay. Well, thank you, Mark Bynes, for all these information, all these sentiments from investors. And maybe another time we'll have the pleasure to receive you on BiTV.
Perfect. And thanks for having me. And I'd be glad to turn up next time. Cheers.